Hi, welcome to another episode of the Fundamental of Accounting series. We have discussed certain basic terms of accounting in the first part of the video, LV1. This is the LV2, learning video 2. We are going to discuss basic terms which one must know before undertaking the study of accounting so that the student is able to understand what is being included in accounting. We have already discussed that there are accounting terms which one needs to know to be able to understand the fundamentals. For example, if you are studying the balance sheet of a company and you don't know the terms which are included in it, you won't be able to understand it. So you are not going to interpret what is being written in the balance sheet, or for that matter statement of income. To be able to understand what is being included in the financial statements, one must need to understand the basic terms. The basic classification of these accounting terms are fourfold. First of all, you have assets. Secondly, liabilities. Third is capital. Fourth is expenses. So whatever terms one has to interact with in accounting are classified under these basic terminologies. Assets we have already discussed. These are the economic terms, economic things, economic assets which are owned by a firm, liabilities which are owed by the firm, capital is something which has been contributed by the shareholder or the proprietor, and expenses which is incurred to generate revenue. So first of all, we need to find out what are assets, what is included in assets. Assets basically are divided into two further parts: current assets and fixed assets. A third part is called intangible assets, which we are going to discuss in another section of this video. But first of all, we need to understand current assets. Current assets are those assets which can be converted into monetary terms very easily and generally within a period of 1 year from what is being stated on a particular date. Current assets include stocks, or which is otherwise known as inventory, debtors, which is known as accounts receivables as well, cash, bank, supplies, and prepaid expenses. The long-term assets, which are also known as fixed assets, includes land, building, plants and machineries, vehicles, investments, furnitures, and fixtures. So basically we divide assets into two parts: current assets and fixed assets. Current assets are short-term assets which can be converted back into money within generally a period of 1 year. Fixed assets are those assets which are long-term in nature, and these assets like land, building, plant and machinery would have a large life period. For example, land doesn't have a particular life. Land will exist forever. Building can have a life of 40, 50, 60, 70 years. Plants and machinery will have a life of 10, 20, 30 years. So these are long-term assets. Let's go to the third part of the assets. The assets which are known as intangible. They're generally included in the fixed assets. These are long-term assets, but they are known as intangibles, intangible assets, the third form of assets. These are intangible assets because these assets are not physical in form. They're not tangible. You cannot see them. For example, land. It has a physical shape. Building, machinery, furnitures, they have physical shape. You can see them, you can utilize them as you like. But intangibles doesn't have a form or shape. These are assets which has legal existence only. You can, like any other normal asset, can be able to buy and sell these assets, but these assets are not going to be seen. They exist only in the books of accounts. They have value, they are legally recognized, and some of these assets can be depreciated, some of them are not. Liability, the third major category. Like assets, these are either short-term assets, short-term liabilities, or long-term liabilities. Like current assets, short-term liability are those liabilities which can be repaid or which has to be repaid within a period of 12 months or 1 year. So these liabilities don't exist in the books beyond 12 months. On the other hand, long-term liability are those liabilities which are generally of 3, 4, 5 to 10, 20 years of duration. So they exist in the books for a long period of time. They will be repaid over a long period of time. Long-term liability include term loans which comes from banks or other financial institutions, like a loan can be generated from a government institution like NABARD. It can be generated as a term loan from a bank like State Bank of India, like for example say uh, Bank of India or Punjab National Bank, or for that matter any bank that is providing a loan to a business to undertake either long-term expansion activities, etc. The second long-term liability is a bond. A bond is issued in the market. The short-term liability includes loans which are payable within 12 months. Creditors are also payable within 12 months. Bank overdrafts, they are not of so large in nature, long-term in nature. Bank overdraft is generally repaid within a 15 days period as mandated by a bank, or 1 month. And outstanding expenses, which are expenses which is needed to be paid within a period of 1 to 3 months. So these liabilities which are required to be repaid within a period of 12 months are short-term liability. The next category is capital. Capital is, as I have said already in the earlier video, that capital is the amount of money that is invested by a business owner or proprietor in the business to start the business. So for example, if Mr. X is starting a grocery business, he wants to buy and sell groceries, he needs to put some money into his own business. With that capital, he can buy the necessary items that will be stored in the business place and later sold to the customers. That is known as capital. If it is a company, then a single individual is unable to pay all the capital. So in that case, a large number of people contribute money to the formation of the business. So when a company undertakes business, the capital is contributed by more than one person. Because more than one person is contributing the capital, that is known as equity share capital or owner's capital, which is essentially the same thing as a single individual contributing to a proprietor. However, the proprietor owns the full amount of the business, but the shareholder doesn't own the whole amount of the firm or the company. Similarly, there is a second category of capital which is known as preference capital. Preference capital, unlike the equity capital, these are creditor capitals. If somebody is contributing share capital which is known as preference capital, then that person will be paid an annual dividend at a percentage which has been agreed between the person who contributing capital and the company which is taking the capital. So in essence, the capital is borrowed by the firm or the company from the individual who is known as preference share capital in exchange for a fixed amount of dividend, which will be described as a percentage of share capital. So this means preference share capital is quite fundamentally different from equity share capital. Equity share capital doesn't come with any fixed amount of dividend percentage. If the firm makes a profit in a particular financial year, then the directors of the company can be or should be in a position to be able to declare a particular percentage of the profit as dividend. Then that percentage of the profit will be paid to the share capital holders, equity shareholders, as distributable profit, and the same is known as dividend. But the amount of dividend or percentage of dividend is never fixed for equity shareholders. But for a preference shareholders, whether a company generally makes a profit or not, the amount of dividend, which is generally described as a percentage of the capital invested, will be paid to the preference capital irrespective of profitability of the firm. Expenses. We have already discussed expense in LV1, and expenses include those items which are spent by the firm, by the proprietor, for furthering the business operation of the firm, and which is generally spent to keep the business running. So if you have a business, you have a place taken on rent to undertake the business, you have to pay rent. So rent is an expense at the end of the period, end of the year. Salary is paid to people who work for the business. Stationery is used in the business like pens, papers, etc. There can be electricity expenses if you undertake business. You have a business premise which has to be lighted. There are lightings, fans, air conditioners, fridges, refrigerators. They are being used. So you have to pay electricity. Audit fee is paid to the auditors of the firm who undertake audit of the business transactions to prepare the financial statements. So these are expenses which must be paid for the business to run. These are expenses, they are deducted from revenue to get to the profit, but that we will discuss later. Revenue. This is the most important part of running a business. Unless you generate revenue, you are not in a position to continue, because a business once formed can be able to run even if there is less revenue or no revenue, but it cannot run indefinitely if there is no revenue or sufficient revenue, because if there is less revenue than expenses, one will make losses. So revenue is fundamental to existence of a business in the long run. One of the major forms of getting revenue is the sales revenue that will be generated. So primary example of revenue is sales. So by sales means by exchanging goods and services with the customer, you get the money, that is known as sales revenue. Other revenues would be sales of investments, sale of assets, commission received by a firm if it is undertaking any commission business, rent received if a business has additional space which can be rented out to others. So these are other forms of revenue, additional revenue. But the primary form of revenue is sales revenue, which is generated by undertaking the general form of business that is supposed to be undertaken. For example, if Mr. X is running a grocery business, the primary form of revenue will come from selling of the goods which has been stocked by the business. So sales revenue, when the uh, grocery business owner sells grocery to clients and receives money. Now come to detailed discussion of assets. Assets, current assets, the first term is stock or inventory. Inventory are those goods which a trader, like a grocer, will keep for resale at his place of business. So this means the grocery which has been all form of grocery, rice, flour, all forms of masalas, dal, turmeric, everything that is stored. Now come to current liability. Current liability, as I said, they need to be paid within 12 months. If the business has purchased from another business on credit, that means, let's go to the example of Mr. X. Mr. X sells grocery, but he doesn't produce those grocery. So he purchases those grocery items from company Y. So for example, if he purchased grocery worth $20,000 from Y and paid only $15,000, $5,000 of worth grocery are on credit. This means he needs to pay grocery of 5,000 which is owed to Y within 12 months. That will be categorized as accounts payable or creditors. Because it is short term in nature to be payable within 12 months, that will be written and categorized as current liability. Similarly, there can be a loan which is short term in nature. Loans taken from any source like a bank, which must be payable within 12 months. Short term loans are given by banks. Bank overdraft is a facility against a current account. Businessmen, grocery owners, small businessmen, MSMEs are small businessmen who doesn't have enough capital to run their business. They open current account with banks, as do grocery owners and any businessman for that matter. When the account, all the business transactions with the bank through a current account, they receive all the money and pay through that current account. The bank can provide them a temporary or permanent facility of withdrawing more than their deposit. For example, the bank permits Mr. X to withdraw 10,000 in excess of what he has deposited into that account whenever he needs it. That must be repaid within a period of 30 days. Generally, it can be extended as well to 60 or 90 days. So that is known as bank overdraft, when a businessman is allowed to overdraw, which means to draw more than what he has deposited in the bank without asking for any specific permission, because the permission is already granted. So that amount of overdraft, what we can draw in excess of what you have deposited, must be agreed, and you don't need permission again and again. That is a recurring facility. You overdraw once, you repay within 30 days, then you can overdraw again in the next 30 days cycle. Capital. We'll discuss equity capital here. We'll come back to a detailed form of discussion on capital in a later video. So equity capital or capital is the amount of money which is invested by the proprietor or the shareholder when he starts the business. This is the amount of money which he can contribute towards the business when he starts the business. He might have a lot of money. For example, a grocery store owner can start the grocery store business by investing $1 lakh, $100,000 that is. But if he doesn't have that kind of money, he can start the business by contributing $5,000. So that is the capital which has been invested by the owner or the shareholder. The capital is invested by the owner or the shareholder if the company is categorized as equity. The equity is owned by the equity shareholders. The shareholders are the real owner of the business. Proprietor is the owner of the business, which is single owner business, proprietorship. But in case of a firm, in case of a big company, there can be a lot of shareholders, because not one shareholder or 5 shareholders or 100 shareholders can contribute towards all the capital of a big business like Apple Inc. or Samsung. There are millions of shareholders of Apple Inc. So they contribute towards the capital of the business, and whenever the company will have profit, they will pay part of the profit as distributable profit to the shareholders in the form of dividend. And one must remember, dividend is very different from interest, because interest is paid on a loan and dividend is paid on equity capital, and the amount of dividend paid to the equity shareholders are not fixed. Intangible assets. Intangible assets are those assets which cannot be seen but can be felt. They can be traded, they can be sold, they can be bought, and they are generally posted into the books of accounts and shown as long-term assets under the heading of intangible assets. The first such asset is goodwill. Goodwill is the amount which is paid by a firm when it purchases another business, another company, in excess of the net asset of the business. For example, company A decides to purchase all the assets and liabilities of the business B for $100,000. But the net assets of company B is only $80,000. That means company A agrees to pay $100,000 in exchange of $80,000 of net assets of company B. So it has paid $20,000 in excess. That's goodwill. That's intangible assets. That will be shown in the books as intangible asset and goodwill. And generally, goodwill has huge amount of life if it is created by the business on its own, and it will not be amortized unless it is recognized. Second item is trademark. A trademark is another intangible asset which is evidenced by a unique word, phrase, or a symbol. For example, if you have seen the picture or symbol which has been used by State Bank of India, that is the trademark. If nothing is written and you have seen the picture, you will understand that this place is State Bank of India. For example, Morgan Stanley. If you go into a Morgan Stanley branch, you will be greeted by the symbol of Morgan Stanley. Apple Inc. is a half-eaten apple as a symbol. The half-eaten apple is the symbol representing the Apple Inc. trademark. So a trademark is something very unique which identify exclusively the product and services sold by a business like Apple Inc., etc. It is legally recognized, and also you must know that it can be sold. The value of a trademark will be determined by due process of accounting standards, and in some cases when it's sold, it can also be taxable. The third intangible asset is copyright. A copyright is generally granted by federal agencies like uh, the United States Copyright Association for publishing and selling various works. For example, if I have written a book, new book, it will be copyrighted to me. If I have sung a song, if I have made a film, it will be copyrighted to the firm, the company, or the individual which has produced it. The music is generally copyrighted to the company which sponsors it, which owns it. That music, that book, or the film cannot be used under any circumstances without specific permission from the copyright's owner. If anyone uses it for commercial purposes without permission, it will be punishable offense. It will be a punishable offense, and they can be sued. The fourth item under intangible assets is a patent. A patent is generally granted as a license when a new technology is developed. If a new technology is developed and the new technology is registered with the patent office, the United States has a very stringent patent regulation, and one has to apply to the patent office for the patent. So if you have created a new machine which has anti-fraud technology, ATM machine, you can get it patented. Once the asset is patented, it will be patented for a few years under regulation. Till those years, that technology cannot be used by others. If they want to use, they will have to buy the license from the original patent holder. For example, if a new medicine is developed, then the patent goes to the developer of that medicine. Others cannot use that medicine, that technology, that formula to bring out new tablets or new medicine. But after the patent period is over, that becomes a generic term, generic take, which others can use. Like copyrights, like trademark, the use of patents without permission is an offense and can be used by the patent holder to sue the infringing party, third party. So that's for it. In today's lesson, I will bring out a new video on the next topic, which is accounting equation, which will form the very basic of creating the balance sheet, and that will be the next video. Hopefully this video was useful to you. You can watch it again after it is finished and try to understand the topics which has been discussed. We'll come back to you with a new video very soon. Till then, bye bye, and don't forget to subscribe to the channel. And you can also email or be in contact through these numbers through WhatsApp if in case you need help. And in the next video we will be starting numerical portions. So whenever numerical portions are done through the video, one example will be there. You can ask for more examples which we can correspond with you. And before going off, please subscribe to the channel. Thank you very much. Thank you.